Fidelity wants to bring pensions back. Should investors be excited? The Great Retirement Experiment. For much of the 20th century, many workers relied on defined benefit pensions. The process was simple and predictable. Employees worked for decades, then retired, and received a guaranteed lifetime income. However, the retirement system changed. Companies transitioned employees into 401k plans. Suddenly, managing retirement became your responsibility. Today, a notable development is occurring. One of the largest financial firms in America believes many workers want the return of pensions. Not literally. However, they seek a solution that offers the security and reliability of a pension. Fidelity is investing billions of dollars in support of this belief. Let's examine what is happening, why it matters, and whether this could benefit retirement investors. For much of the 20th century, many workers relied on defined benefit pensions. The process was simple and predictable. Employees worked for decades, then retired, and received a guaranteed lifetime income. The investment risk was borne by the employer. However, the retirement system changed. Now, you had to make key decisions: how much to save, how to invest, when to retire, how much to withdraw. Perhaps the most challenging question of all: how can you ensure your savings outlast your retirement? This shift created millions of new investors, but also led to widespread anxiety among retirees. Many people believe retirees are most concerned about stock market crashes. Others point to inflation. Some cite taxes as the primary concern. However, a deeper fear often exists. The greatest concern is outliving one's savings. Consider reaching age 85. Your portfolio has declined. Healthcare expenses continue to rise. You realize you may live another 10 years or more. This fear can be overwhelming. Retirement is not only about accumulating wealth. It is also about converting that wealth into reliable income. This transition is often much more challenging than accumulating assets. Fidelity recently announced a new retirement product called Freedom Lifetime. The concept is straightforward. Take a traditional target date retirement fund. As retirement approaches, an annuity component is gradually added. By age 65, about 25% of the portfolio may be allocated to insurance contracts from providers such as New York Life. These contracts can provide a guaranteed lifetime income. In effect, a portion of the 401k functions similarly to a pension. Fidelity plans to roll out the product beginning in 2027. This represents a significant change in retirement planning. And Fidelity is not alone. Vanguard and BlackRock have already introduced similar concepts. The largest retirement firms in the United States appear to be adopting similar strategies. Something important: these firms recognize increasing demand for predictable retirement income. Why are financial companies renewing their interest in pensions? The answer is demographics. The American population is aging. Approximately 1/4 of the workforce is now 55 or older. Millions of baby boomers are entering retirement. Many individuals have spent decades building their assets. They now face a new challenge. They must convert their savings into reliable income. Accumulating wealth requires one set of skills. Managing and spending it wisely requires another. Many retirees find this transition challenging. A guaranteed monthly payment helps reduce uncertainty. An annuity is a contract with an insurance company. You pay a sum of money to the insurer. In return, the insurance company guarantees regular income payments. These payments may last for a fixed period or for the rest of your life. The primary benefit of an annuity is predictable income. You can rely on continued payments even if markets decline or if you live longer than expected. This reliability can offer significant peace of mind. Annuities are designed to address one of retirement's greatest challenges: longevity risk, the possibility of outliving your savings. Retirees may find these products attractive for several reasons. First, they offer predictable income. Receiving monthly payments can help reduce financial stress. Second, they provide protection from market volatility. Some of your retirement income is no longer dependent on daily stock market fluctuations. Third, they offer protection against outliving your savings. If you live to 95 or even 100, payments will continue. For many retirees, this certainty is highly valuable. This is especially true for those who prioritize stability over maximizing returns. However, all financial products involve trade-offs. This product is no exception. The primary trade-off is reduced flexibility. Funds allocated to an annuity often become less accessible. There may be a loss of liquidity. You may lose some control. Additionally, guaranteed payments typically do not appreciate as rapidly as a stock portfolio during periods of strong market performance. Inflation presents an additional concern. According to Fidelity's announcement, the guaranteed income payments are not automatically adjusted for inflation. As a result, a payment that is sufficient today may have significantly reduced purchasing power in 20 years. This risk is frequently underestimated by retirees. As investors, we should avoid adopting extreme positions. The decision is not simply between annuities and stocks, nor is it a matter of choosing between pensions and investment strategies. The central consideration is achieving balance. Many effective retirement plans integrate multiple sources of income. These may include Social Security benefits, investment portfolios, dividends, bonds, cash reserves, and in some cases annuities. Each component serves a distinct purpose. These purposes include growth, income, liquidity, and protection. The objective is not to maximize any single component. Rather, the aim is to construct a system that provides financial security and peace of mind. It does not pertain to annuities, nor is it solely about pensions. The essential insight is that retirement planning evolves throughout an individual's life. When you are 30 years old, growth matters most. By age 65, generating income assumes greater importance. The competencies necessary for wealth accumulation often differ from those required for effective wealth accumulation, TH. Consequently, retirement planning warrants the same level of consideration as investment strategy. Ultimately, all investors encounter a common challenge: transforming an investment portfolio into a reliable income stream. Fidelity's introduction of a pension-style 401k product exemplifies an emerging trend within the retirement planning sector. A significant proportion of retirees seek financial certainty. They prioritize predictable sources of retirement income. They also desire reduced exposure to unexpected financial fluctuations. The suitability of annuities as a solution varies according to individual circumstances. However, the broader trend toward pension-like features in retirement products is noteworthy. Following several decades of a shift away from traditional pensions, the retirement industry is now reintroducing certain pension characteristics. This shift is not driven by investor demand for increased complexity. Rather, it reflects a widespread desire for clarity regarding retirement outcomes. Will my money last? This question has arguably remained the central concern in retirement planning. If you enjoyed this video, subscribe to the Illiterate Investor. Because building wealth is important, but creating lasting financial freedom is what truly matters.